Welcome back, guys, to taxes, risk, and fees. Or is it risk, taxes, and fees? Or is it fees, risk, and taxes?
Those
Anyway,
those are the three biggest killers in retirement: risk, fees, and taxes. And we are all about reducing and minimizing those to help our clients reduce their stress.
and I'm Raz. This is Daniel with Higher Ground Financial Group, and we're going to help you make sense out of retirement. So, what we're going to talk about today is right now in this sequence is sequence of returns risk. What does that mean?
So sequence of returns is one of the biggest risks as you enter retirement. It's the idea of when are the bad years going to come? And not really how bad will they be, although bad years or bear markets, they can definitely, nobody likes bear markets, right?
Right.
But when are they going to come, and are they going to come sooner or later? So if you're retiring today or the next few years, you will probably experience several really bad years over your lifetime.
So, on average, you're going to get one bad year every 5 years, right?
Right. So about every 5 years, if the market's up 4 of them, it'll be down 1 of them. So if you're going to live another 20 or 30 years, you're going to have 4 to 6 really bad years or more. And the problem comes if those bad years are early in retirement, because if they happen early on, then you have a cascading effect that really wipes you out completely. Because while you're working, the bad years don't affect you so much because you keep investing more.
Yeah.
And if the market crashes and I'm going to put more money, I'm buying on sale, right?
Yeah. I mean, over the last 20 years, my stock portfolio has done really well. And the reason is, even with the huge market crashes in early 2000 and 2008 and 2020,
you keep investing.
Right. So every paycheck, money's going in. So I'm seeing growth in my assets, even with the drops.
So that's when you're investing and when you're accumulating, right? And there's really two different modes, two different phases of investing. There's the accumulation mode and then the distribution phase.
Right.
And most advisors talk a lot about accumulation. We want to grow your pile of money. All right, well, now you're there. If you're within a few years of retirement, this is the perfect show for you, because that's what we talk about. People that are entering retirement or that are already retired, now you have to distribute that money to yourself.
So are you saying there's a different math calculation, growing your money versus taking money out?
There really is, because while you're accumulating, if you don't take any withdrawals, it doesn't really matter when the bad years come. As long as the math works out, eventually you're going to have a good return over the long period. But if you're taking money out, you might have a great average return and you can still be completely run out of money. So imagine this. Imagine if you retired in the year 2000. Then we had the dot-com bubble, 2001, 2002, 2003, 3 bad years in a row.
Wow.
And clients and people that retired in the year 2000 and had a mostly market portfolio, they were completely wiped out. Even if they took only 4 or 5% out of their retirement accounts, they were completely wiped out after maybe 10, 12, 15 years. And imagine, you're already set for retirement. You've got the perfect number, and you think, well, I mean, the market's been averaging 8, 9, 10%. I should be able to take out 5. That's okay. And then you have a couple bad years in a row, and the loss happens, and then you also take a withdrawal, so that makes it like a double loss. So that's the sequence of returns risk. That's the problem. So for the solution, then you got to go to our website and find out. We'll tell you in a minute, but you can go to our website, riskfeestaxes.com, and schedule a meeting with us, and we'll give you some specific tips for how to minimize and to handle sequence of returns risk, the risk that the bad years come early on. They will come. There will be bad years.
Right.
There'll also be good years.
So let's talk about this for a bit. If the market drops, let's say it drops by 50%, then I just need 50% to get back to where I was, right?
No, you need 100% return to get back to even. So let's use the example. You have $100 and you lose half of your money. So now you got $50.
Okay. So if I get 50% return, what'll I get?
Well, 50% return now would only be $25 because you only have 50 now.
Right.
So 50 plus 25 is only $75. So if you want to get back to 100, you have to gain 100%.
Wow. Now, that's tough to do. So if your portfolio drops by 50%, that means you have to have 100% return just to break even before you have any new growth. So if that takes 2, 3, 4, 5 years to do that, that means you have no growth for that many years. And if you're taking money out at the same time, you're really the snow's melting fast for you.
Yes. And so that's the reason that it's important to handle sequence of returns risk. So what are some solutions? One of the most common, well, it's not really that common yet, but it's becoming more common, and it's talked about a lot because it's very innovative, is the idea of a volatility buffer. So a volatility buffer is an account that is not in the market. So people often talk about being diversified. And when somebody says diversify, and if you have an advisor and he says you're really well diversified, usually what they mean is you've got a good mix of a whole bunch of different stocks and bonds and mutual funds. So It's kind of like if you have a boat and you're like, well, all my money's in one boat. I don't like this. I want to diversify. So you buy 4 more boats. Now you got 5 boats. What's wrong with that picture?
They're all still in the same pond. So if the pond has a tsunami, they're all going to sink.
And so even if you have a whole bunch of different sectors, a lot of them affect each other. The economy is so intertwined these days that they can all be affected. Anything that you think of, most things you think of as a traditional investment is a opinion asset. It's an opinion-based asset. And that means the value is based on somebody else's opinion.
So not your opinion, what somebody else thinks that's worth.
Exactly. So let's give some examples. Stocks will be an opinion-based asset.
Because you might think it's worth $500, but if I'm only willing to pay $300, then you're only going to get $300.
And bond funds are also based on market opinion, what somebody will buy it from you for. Your house is an opinion-based asset. So most people have most of their money in opinion assets, and that's not a bad thing necessarily, but
is there some other kind of asset that's not opinion-based?
There's contract-based assets. So you probably have a contract-based asset, and it's called a bank account. So if you have $10,000 in your bank account or $100,000 in your bank account, and you wake up tomorrow and the market crashed and the bank calls you and says, oh, you actually don't have 100,000 anymore. You only got 80,000 in your bank account. You go ballistic because it's guaranteed in the contract you're going to have.
That's right.
If you have a bank checking account or savings account, you will have that. It will not go away when the market crashes. So there's plenty of other contract-based asset. Usually those are, money with either the federal government, like federal treasuries, or banks or insurance companies, or really anybody. You and I can have a contract.
A rental contract too is a contract-based asset.
Right.
So basically, you diversify between opinion-based assets and contract-based assets in order to have a more stable environment for your retirement. And that's one kind of diversification. What's another kind of diversification?
Another kind of diversification is tax diversification. So tax diversification is where you don't have all of your money in IRAs and 401ks. I like to tell clients that deferring your taxes is one of the biggest scams that exists today in the tax code. For many, many people, especially if you make above average income, deferring taxes is one of the worst things you can do. And that does put me at odds with a lot of CPAs and accountants, because if you ask your CPA, what's the number one thing I can do to reduce my taxes, he'll say, contribute more to your IRA or 401k. And I say that's a terrible idea in many cases, because while what your CPA is telling you is going to save you money today, does it really save you money over your lifetime? No, not necessarily. In many cases, paying less taxes today costs you more in the future. So we want our clients to minimize their taxes over the long term. And that's why we always talk about all 3 things: risk, fees, and taxes, not just risk, although we talked a lot about risk in this segment. Risk, fees, and taxes. So again, go to our website, riskfeestaxes.com, and you'll be able to schedule a meeting and find out where and how we can help you and give you fiduciary advice for your situation. So again, when you're dealing with sequence of returns, though, which is what we've been talking about, how do you handle when the bad years come? Well, if you're in a contract, well, then there's no sequence of returns because the returns are guaranteed, right?
Right.
If you have a CD and the CD is paying you X amount of dollars per year in interest, you always get that. So there's no predicting it. It doesn't matter what the market does.
Right. So the market drops by 30, 40, 50%. It doesn't affect your what is it? The volatility buffer?
So are you saying you should pull everything out of the market and put it all in contracts?
No.
No, not necessarily. What you need to evaluate all your investment strategies, but think about diversifying between opinion assets and contract assets. And then when you have a large portion in contract assets, that can be your volatility buffer. That can be an account that you can draw from when the bad years come.
Right.
Because if not everything is in the market, then the market crashes, but you still need income. Take your income out of the bank or your other safe accounts.
Right. And you heard an ad campaign a while back that said, what is your number? What is your number? How much should you have saved for retirement? That's not really the right question. The question is, how much income, tax-free income or net after-tax income are you going to have? And that's going to be a different number for different people. Depends on what you need. And so if you have the money in a volatility buffer, you can much better control how much money you can take out, even in bad times, because that's the key. We don't know when the bad times are going to come, but we still need to buy food. We still need to pay mortgages or utilities or taxes or whatever, property taxes, things like that, or take a vacation. And if the market drops by 50%, boy, wouldn't it be terrible if half our money was gone all of a sudden? I have a heart attack trying to figure out where to take the money to be able to live. So volatility buffer evens that out. So having at least half or 2/3 of your money when you're retired in a volatility buffer allows you to be much more at peace, allows you to control your income and not really be concerned. Sort of like if you're at a poker table, right? You're playing poker, you're doing well, you got your winning hand, you got a whole bunch of chips piled up. At some point, you got to take those chips off the table. You don't want to risk all those chips still, right?
Right.
Well, if you already won the game, you've got enough money, and that's the key. How much is enough? That's where we come in, Daniel, with your help. As a tax attorney, we try to figure out what kind of income, how much income is you really need, and can we get that to you? And I can tell you that most of our clients, after they meet with us, they end up having 50% more income than they thought they would.
And it really depends on your situation. So this is an example. It's not guaranteed for you, but when you meet with us, that is what our experience is. Most of our clients have significantly higher income after working with us because we're able to show them ways to combat sequence of returns risk. Sequence of returns is where the 4% rule comes from, or the 3% rule. If you ask 10 different advisors, how much can I take out safely in retirement without running out of money? Most of them are going to say 3 or 4%. And
even though you're getting a much higher rate of return sometimes. You could be getting 20, 30% rate of return some years, but because you don't know when the market's going to drop, you can only safely take out about 3 or 4%.
And so if you have your money, some of it anyway, safe and protected from loss, that's not in the market, that's in a contract asset instead of an opinion asset, that allows you to take out a lot more money each year in retirement and never run out. So not only did you reduce or eliminate risk on a large portion of your money, you also increased your income. It's amazing how that works. Most people think the opposite. They think you have to take risk in order to get a better reward. That's not always the case.
So mathematically, instead of taking out 3.5%, you can take out almost 6 or 7%. That's like double your income from the same amount of money because you are not ever going to go backwards and negative.
And again, those are based on probabilities and thousands of scenarios we run to find out what is the most likely to happen. But
So
we
it's
have
all
a
about
similar
the math.
Yep. And we have a similar confidence rate with a much higher income if you have a good portion protected. So again,
and we have white paper studies to showing that. So it's not just our words. We have many much smarter people than us from different places like Harvard and MIT and places that have done a lot of calculations and shown that these things, if you have the proper allocation into a volatility buffer, you're going to be much safer and you will be able to spend a lot more money safely.
So go to our website, riskfeestaxes.com, and we'll be happy to share with you what is a fiduciary advice for your situation and how to reduce or eliminate risk in your portfolio, move you somewhat to contract-based assets so that you have that volatility buffer and you can eliminate the sequence of return risks. So it doesn't matter. You should be able to retire and you don't care when the market crashes because it will never change how much income you have in retirement. So again, our website is riskfeestaxes.com. We'll be happy to share with you some specific advice for your situation.
All right.